Welcome to our module on closing entries, Module 6.2. At the end of each fiscal year, there are certain accounts that we need to sort of reset to zero in order for us to track an organization's progress throughout a fiscal period, throughout a year. Those include what we call temporary accounts. They include our revenues, our expenses, and our dividends. If we think about what our readers of financial statements are looking for, they don't want to know how much revenue we've generated over the lifetime of our business. They want to know how much revenue we've generated over a period of time, typically a given year. Same thing for our expenses, and same thing for dividends. We don't want to know how much of the income has been distributed out over the lifetime of the organization. We want to know how much has been distributed over this year from current earnings or from retained earnings. So those accounts are what we call temporary accounts, and in order for us to track the activities in these accounts over 1 year, we have to bring our balances back down to zero so we can reuse the same accounts and start again to measure for the next year. Of course, there are a number of accounts that remain open and we carry the balance from year to year. Those are things such as assets, liabilities, common stock, retained earnings, all of those shareholders' equity accounts. And again, we want to ensure that if we have an asset in use over multiple years, of course we want them to reflect that in our books on an ongoing basis. We call those permanent accounts, and we have no closing entries related to those accounts, just simply the temporary accounts. So there are a few steps to closing the books, and so we typically start by closing our revenue accounts. And we're going to use an account which we call income summary. An income summary is a very, very temporary account. We only use income summary to expedite the closing of our books. So we really only use our income summary account in this process. So first thing we need to think about is if we're going to close our revenue account, and if we think about what our revenue account looks like, revenue accounts typically have a credit balance. And so if we have a credit balance, we're going to need to provide a debit entry of the equivalent amount in order to bring this account to zero. And so we need to debit each revenue account. So we may have a service revenue, sales revenue, fees earned, any of those revenue accounts. We're going to debit each of them for their balance and credit what we call income summary. So again, we'll have this income summary account. And if we're debiting our revenue, we're going to credit our income statement, our income summary. The second step is to do very similarly with our expense accounts. Now, if we think about our expenses, typically they have a debit balance. And so to bring them to zero, we're going to need to provide an offsetting credit. Okay, so we're going to debit each of our expense accounts, credit each of our expense accounts and debit our income summary for the full balance of each of those accounts. All right, and now we have this other temporary account called income summary. And so once we've done those entries, we're going to calculate what our outstanding balance is. So if we have a profit situation, we're going to end up with a credit balance in our income statement. If we were in a loss, we would have a debit balance in our income statement. And this is really just thinking about it's our revenues, the amount that we've credited in this account, minus our expenses, the amount that we've debited. And so if our revenues outweigh our expenses, we have a profit. And we'll have a credit balance in income summary. And so in order for us to close income summary, we first have to tally our balance. And then we need to bring it to zero again. So we're going to include an offsetting credit or debit depending on the type of situation that our organization is in. Okay. The last accounts we need to close are our dividend accounts. And again, we're going to debit our retained earnings and credit our dividend account. So if we think about dividends, again, typically we have a debit balance. If we want to bring it to zero, we need to offset with a credit. Again, those go directly to our retained earnings. They're going to reduce the retained earnings inside of our organization. Okay. When we close income summary, again, the offsetting entry goes directly to retained earnings. Because if we have profit, we're going to increase our retained earnings. And if we have a loss, we'll decrease our retained earnings based on that adjusting entry. So let's go through and look at some of these. So we have this information at the end of the fiscal year for Go Get 'em Corp. We have the following balances available. So the first thing we need to do is understand whether they are temporary or permanent. So let's go through these accounts and just validate what type of account we're dealing with here. So cash would be a permanent account as an asset. Accounts receivable, permanent. Rent expense, temporary. Service revenue, temporary. Bank loan, permanent. Dividends, temporary. Common stock, permanent. Interest expense, temporary. Advertising expense, temporary. Sales, temporary. Inventory, permanent. Okay, so now let's work through the steps of our closing balance. So step one was to close revenues to income summary. So let's go through our revenue accounts. So we have a service revenue. It has a credit balance typically, so to bring it to zero, we need to debit service revenue for $8,000. We also have sales, which we need to debit for $3,500. Those are only income, our only revenue accounts, and so we're going to credit our income summary for $11,500, the entire revenues. Next, we're going to close our expenses. And so again, typically our expenses have a debit balance, and so we're going to credit income summary, and we're going to credit rent expense, ad expense, interest expense. I think that's all of them. Okay, so let's see. Rent expense was $1,800, advertising expense $1,500, and interest expense $500. Okay, so all in all, we have $3,800 that we need to put into income summary. Okay, our third step is to close income summary. So if we think about our income summary account, let's just draw that T account out here. We have $11,500 from this transaction here, and we have $3,800 from this transaction here. And so all in all, we have $7,700 in a credit position. So in order for us to bring it to zero, we'll need to debit income summary, for $7,700, and credit retained earnings for $7,700. Last but not least, we're going to close our dividends. And again, we're going to credit our dividend account for the amount, $1,500, and credit retained earnings for $1,500. Okay, there's an example of our discussion on temporary and permanent accounts and closing entries, as well as the different various entries that we'll process to close our books and get them ready for the next year. The last step in our accounting cycle is then to prepare a post-closing trial balance, again ensuring that any of these transactions that we posted have still maintained our overall debits equaling our credits. Everything should still be in balance. And then we'll start the accounting cycle from scratch the next year and start tallying things up again. All right, thanks so much, and best of luck in your studies.